Great news just dropped. The SEC, the Securities Exchange Commission in the United States, has approved a major change for crypto exchange traded products, ETFs or ETPs, specifically allowing something called the in-kind creation and redemption. If you're scratching your head wondering what that means and why it's an extremely big deal, don't worry, I'm here to break it down for you. Let's get going. Hey guys, my name is 𝗙𝗡𝗙 and I bring you these kind of videos, very short, informative, so you can make your decisions within crypto. If that sounds good, subscribe to the channel, smash the like, and share it with your friends. Let's get going. Let's start with the basics. What are ETFs? An exchange traded fund, or ETF, is a basket of investments that you can buy and sell on the stock market. You probably have heard about the Bitcoin ETF that allows you to get a Bitcoin or get exposure to Bitcoin through a traditional investment vehicle, being an ETF. The interesting part is they call it a paper Bitcoin because you don't actually own the Bitcoin, you own a share in an ETF that eventually holds the Bitcoin and custodies it basically for you. This means that these big ETFs basically handle the buying and selling of the shares for regular investors like you and me. If you buy a share of Bitcoin ETF, you pay dollars, get the share back, and if you want to liquidate that share, if you want to exit your position, you have to sell that share back to the provider, and then you can get your cash back. Now, the old way was cash only. That was a cash only rule. When the SEC first approved Bitcoin ETFs in January 2024, they set a rule which said ETF providers could only create or redeem ETF shares using US dollars. This basically meant that if an investor wanted to exit a Bitcoin or Ethereum ETF, the provider had to sell the Bitcoin and give the cash to the investor. They could not redeem Bitcoin. Now, this sounds normal, but it's actually not normal. It's a rule made only for the Bitcoin and Ethereum ETFs. For other commodity ETFs like gold and oil, providers can actually exchange shares for the actual community. So you can exchange your gold ETF shares for a pile of gold. This is what we call the in-kind method, and it has been standard for years. Now, why was the cash-only rule a problem when it came to Bitcoin? So the SEC and the investors noticed that sticking to cash-only made Bitcoin and Ethereum ETFs much more expensive and less efficient. Here's why. Extra costs. So one, converting Bitcoin to cash every time involves a fee and some extra steps, which raises overall cost. Second, price slippage. So when providers sell Bitcoin or buy Bitcoin for that matter, the price can shift slightly from the price that they wanted to execute it on, causing losses or insufficiencies, and again, lost time. Now, this setup made crypto ETFs a little bit less competitive compared to other commodity ETFs, but we know that there is no second best. But then came yesterday. Yesterday, the SEC changed the game forever. So starting with this new approval, providers can now create and redeem ETF shares using actual Bitcoin or Ethereum instead of just cash. It's an incredible thing. Here's why. Now, Bitcoin and Ethereum ETFs will work exactly like other commodity ETFs like gold or oil. Providers can trade real assets for their shares. So one, there will be lower cost. Skipping the cash conversion, transaction cost, time drops makes the ETFs just much cheaper, faster, more convenient, and eventually more appealing. But also it can attract more bigger investors. It's lower cost, more efficient, and also a much more familiar setup to what it was for other commodity investment. Also, another big thing is the tax benefits. You see, under the old cash-only rule, when providers redeem shares, they had to sell Bitcoin or Ethereum for cash. Now, if those holdings had gone up in value, they basically had something called a capital gain, and that means that they had to pay capital gain tax. With the new in-kind rule or in-kind redemption rule, providers can simply swap ETF shares for Bitcoin and Ethereum directly, therefore there is no tax hit on capital gain. The question is, does it even affect you as a regular investor? And the answer is yes. When ETFs have to pay taxes on capital gains, they might pass those costs to all shareholders or something called the capital gain distribution. So with in-kind redemption, this tax burden is basically be a cost efficiency for the investor himself, which would again mean possibly it will attract more bigger players. It puts Bitcoin and Ethereum ETFs on par with traditional commodity investments, which could lead to more growth, more stability, and of course, more appealing crypto market for traditional investors. I do believe that this change could trigger greater inflows into the ETFs, but we are all yet to see that. Guys, if you have enjoyed this video, if you learned anything from it, let me know in the comment section. I always read the comments and always reply to them. I appreciate if you do it. And if you got any value, subscribe to the channel, smash the like button, check out this video if you want to make money even when you sleep, and subscribe here. Guys, thanks for watching. I will see you in the next one. Take care.